Hi, Gary Merzinski, and I'm back to talk about Chapter 7, where we will be discussing inflation. The content for this presentation is taken from the Macroeconomy Today by Schiller and Gebhardt, published by McGraw-Hill. In this chapter, we'll be talking about what inflation is and how it's measured. We'll also talk about who is hurt when inflation happens and who is helped when inflation happens. Now, you probably never thought about inflation as being helpful to anyone, but it actually is. We'll talk about that. And what's an appropriate goal for price stability? In other words, what is an appropriate amount of inflation that's not a problem, or maybe no inflation is better? We'll talk about these two ideas. Why is inflation important? Well, when it gets really bad, it could lead to the ruin of a country, more or less. And after World War I, Germany was in a shambles. Their economy was in a shambles. Their currency was experiencing what you're going to learn in this chapter is known as hyperinflation. Prices rising so fast, nobody wanted to hold the currency. They were trying to convert it into whatever assets, tangible assets they could, and hold those assets. Nobody would save money. Nobody would invest money or make long-run plans. This led to the collapse of the government and led to the rise of Hitler. And so this is again known as hyperinflation. More recently, Zimbabwe, and there are some other more recent examples of this same kind of runaway inflation. So here's an exercise. Suppose the price of a good is $1 and the price is doubling every day, as might happen with inflation. What will its price be in 10 days? Here's the answer, $512. If something costs $1 and doubles every day for 10 days, it'll cost $512 in 10 days. How about in 20 days? This is less than 3 weeks. $524,288. And I give you a simple formula down below. This is not really economics, but it's kind of interesting. In this example, or this formula you see down below, X is the amount of money you're starting with. We use 2 to the n minus 1. 2 because we're doubling that amount. If you were going to triple it, you would say 3 to the n minus 1. And then n is the number of days, the number of periods. So you can plug these numbers in there and you'll get those same answers. So what is inflation? Now the definition I like to use is it's a rise in the overall level of prices in an economy. This is the definition from your textbook. An increase in the average level of prices. And then they explain, but it's not a change in any specific price of a good. In other words, if inflation is 2.5%, it doesn't mean that the price of everything is going up by 2.5%. That's the average change. So I can understand why they use average, but I like to think of it as an overall level of prices rising by that amount. So how do they come up with this inflation rate? Well, we're going to address this in the next video, but just briefly I'll explain. What they do is they assemble a hypothetical basket of goods and services. These are the kinds of things that people buy, and they look at what percentage of people's incomes are spent on these different things. So some of it is spent on housing, some of it is spent on utilities, some of it is spent on clothing, some is spent on food, travel, leisure, education, and so on. And then they go out and measure those prices every month, and they come up with what's called a price index, which you're already used to using. So we'll talk about how our government comes up with the consumer price index in a little bit more detail later in the chapter. And again, that's in the next video. But that's what they use, that price index, from year to year to measure inflation rate. When prices go down, not a problem we've had in a long time, that is what's known as deflation. Deflation is a bad thing, and we'll explain why that is. And you might think, well, deflation, that would be great if prices went down, right? Well, not when the overall level of prices goes down. We'll explain that a little bit later. Now, the idea of relative prices is interesting. Again, when the inflation rate is computed, and let's say it's 2.5%, it doesn't mean everything goes up by 2.5%. It could be that some products go up by 5%, half of them, and the other half of the products go up by 0%, meaning they don't rise at all. And then that means the relative price change or the average price change would be 2.5%. Or you could think of any product category, and agricultural products are a great example of this because they have very volatile prices, because any given crop in any given year is dependent on the climate and weather conditions. It could be a poor growing season for oranges and a great growing season in a different part of the country for apples. And so the relative price of fruit, for example, would be the average of maybe one price has gone up and another price has gone down for different reasons. The relative price would be somewhere in between. And we'll look at an example of that too. When this happens, you adjust your buying behavior, don't you? This is what we talked about in Chapter 5 under consumer behavior. Inflation is a rise in the average price of all goods, again, or the overall level of prices. And one more time, it doesn't mean prices of everything are rising. The prices of things are actually going down. And these would be things that are not in growing demand, in declining demand. Those prices normally go down, right? And then those products eventually probably stop being produced. But here's an example of prices that have gone down long term. Now, as you look over this list, you can see the price when the product was first introduced in the market. The pocket electronic calculator, for example, in 1972 for $200. Now you can get one for, now 2010 price, that's probably an average price. You can get one in the dollar store. And digital watch, $2,000 in 1972. You can get one of those in the dollar store too. And so, what do these all have in common? These are not a random cross-section of products that we sell in our economy. These are all technology products that typically do go down when they're first introduced into the market and there's no competition, and these companies are recovering R&D costs. They're very expensive, but eventually they come down in price. So this is, these are not typical products. These are technology products. So what are the effects of inflation? Let's start talking about that. Well, you recall the difference between nominal and real values. In Chapter 5, we talked about the difference between nominal GDP and real GDP. If you had a list of GDP numbers collected over the last 10 years and you want to know how much economic growth we've had and you compare those nominal GDP numbers, the complication is that inflation happened each of those years, probably. And so maybe some of the increases in GDP from one year to the next, nominal GDP, is due to prices going up. What amount of the increase was due to actual growth, economic growth? So we adjust them and we compare real GDP numbers. Same thing applies to your income. If your nominal income goes up by 4%, but there was 3% inflation, then your real income only went up by 1%, right? So nominal income is income measured in dollars of the year that you earned the income. And then real income is when you adjust that number to dollars of another year. So again, if you had your nominal income each of the last 10 years and you adjusted them to 2019 dollars, then you have a different list of numbers, and those are your real incomes for each of the last 10 years based on 2019 dollars. Then the dollars are constant, based on constant prices, really, is what this should say, because then it's based on prices of 2019. So when inflation happens, money is redistributed. So there are winners and losers. And when financial institutions are involved, they are anticipating inflation, but then, so they're estimating what it would be, but then inflation could be more than they anticipated or less than they anticipated, and in those cases, money is redistributed. There are different types of effects of inflation. 3 kinds of effects: price effects, income effects, and wealth effects. So we'll go through each one of these. First of all, price effects. When inflation happens, you're a winner if you are buying products that are rising in price more slowly than the inflation rate. And the reason for that is it is assumed that your nominal income is being adjusted each year, that it's going up by approximately the inflation rate. And that has been true in our economy. Employers typically, maybe not every single year, but long term, wages are rising at the same rate as inflation. So 2 to 3% per year long term. So if that's happening, if your income is being adjusted by approximately the same as the inflation rate, and let's say you happen to be buying products that are rising in price faster than the inflation rate, then you're losing. If you happen to be buying products that are rising or maybe even going down, or like I said, rising at lower than the inflation rate, maybe by 1% per year, then you are a winner because your income's rising faster than the prices of the products you're buying. And one example that's pointed out here is college education has risen faster than the inflation rate by a good deal for a long period of time. Now, this is giving you information for the last 10 years, but really this is something that's happened for 30 years. And my personal experience, I think 35 years ago, it's risen really substantially. So in the last 10 years, though, private college students, so this is private colleges and universities, tuition has increased 8-fold in the last 10 years, whereas, again, inflation has been like 2 to 3% per year. So if you happen to purchase or spend a good bit of your income buying college education in the last 10 years, then during those years, you are worse off than the average American because your income is only rising by the inflation rate. Now, most people don't pay for the college education only in the years that they're in college. They usually finance it and then pay on a loan for another 10 years, let's say. Well, then it extends for those 10 years because you're locked into the prices of the years that you went to college, and then you're paying that back over 10 years. So you're actually losing for those 10 years as well, on average. But that only happens one time in your life, typically. I mean, you could go back to college later in life too, but someone that's retired, for example, is spending none of their income, most people anyway, on college education. It's a small percentage of the population in any one year that are purchasing this product. In 2019, the inflation rate was 2.3%. And once again, that does not mean that every price of every product adjusted upwards 2.3% in that year. That's the average inflation rate. Some prices actually went down, some prices went up. The products that have the most volatile prices are food products, agricultural products, and other food products. Energy also affects the price of food because if the price of gasoline were to go up a lot, for example, then it's more expensive to transport the food, to distribute the food throughout the country. That makes food prices go up. And health insurance, of course, especially in the last 10, 15 years, has been increasing really fast, much faster than the inflation rate for a long time. So here are just some examples. You can see that gasoline went up by 12.8% in 2019 over the prior year, and that's much bigger increase than the inflation rate. And then some food products. Lettuce went up in price, hot dogs went up in price, bananas went up in price, but we actually had oranges and apples go down in price. It must have been a good growing year. There must have been an increase in overall supply of apples and oranges. Maybe it was a really bad year in 2018. I don't have that answer for you, but that's going to be my guess. Maybe it was a bad year, bad growing season. And of course, agricultural products, it's the weather conditions and climate, and that can affect the growing season. If it's a very dry growing season, then there's a decrease in overall supply of those products, drives the price up. So you'd have to know what happened the prior year to be able to explain what happened with apples and oranges, why they came down in price so much. Now, income effects. We just talked about the price effects when inflation happens. Now, the income effects. I've kind of explained this a little bit already. People, it is assumed that if you're in the labor force, that your nominal income, long term anyway, in any given job should be rising by approximately the inflation rate. Your employer really should be giving you, used to be called a cost of living allowance or a COLA increase, and the federal government still uses that term. Private employers no longer use that term because then people can very easily track inflation and see whether they're getting that or not, whether they think they deserve to get it. But still, long term, wages rise by approximately the inflation rate because your company is making 2.5% more in revenue when prices go up by 2.5% if they're the average company. So why shouldn't their wages rise by the same percentage? That's the idea, right? Well, if you're on a fixed income and inflation is happening, then that's not happening, right? You are losing. So if you are on maybe you are drawing a pension that's a fixed amount for the whole period that you're retired. If that's the case, then you are losing when inflation happens. If your nominal income is rising by, let's say, 4% per year long term, and the inflation rate has been 2.5%, then you are a winner. Now let's talk about when there is a loan. I mentioned this already, and there's going to be a graphic coming up in a couple slides that'll make this a little bit more clear. A bank that makes a loan, let's say they expect for there to be, maybe it's a 10-year loan, and it's a home equity loan. And they would never make a loan at this low of an interest rate, but let's say they're going to make this loan at 3% interest. So they're going to expect 3% interest income per year. What if they expect the inflation rate to be 3% per year each of the 10 years, and that's just their estimation? They wouldn't loan the money at 3% because then they wouldn't make any money because you're paying back that loan, the borrower is paying back that loan in dollars that are less in value. The purchasing power of the dollars they're paying back to the bank are less than in the year the loan was made. So they build in an inflation premium. So if they really would like to earn 3% interest income, and if they expect for there to be 3% inflation every year each of the next 10 years as their estimate, then the inflation premium would be 3%. They would loan the money at 6% interest income. As I said, there's going to be a graphic that will show you how this works. Well, what if they do this and then inflation ends up being 6%? Then the bank clearly loses, right? And the borrower clearly wins. What if they make this loan and the inflation rate ends up being 1% per year each of those 10 years? Then the bank wins and the borrower loses. Again, I'm going to show you a graphic that will help you to understand that. So who wins when inflation is happening? Again, if your nominal income is rising faster than the inflation rate, you end up better off. If inflation is higher than expected in a loan situation, again, the borrower wins because they're paying back their loans in cheaper dollars. And then, I didn't mention this one yet, but if you are a business that sells a product and the price of your product, because of market conditions, is rising faster than the inflation rate, you are a winner because your resource costs should not necessarily be rising faster than the inflation rate. In other words, you can be giving your employees 2.5% raises if that's what the inflation rate has been. And if the price of your product is rising at 5%, because that's how much prices are going up in the market where you're selling your product, then you are a winner. If the price of your product is rising by only 1% per year and the inflation rate is 2.5%, then it is expected that you're going to be giving your employees 2.5% raises long term anyway, or you'll lose them, they'll go somewhere else to work, then you are losing as a business. A moderate amount of inflation year to year, say 2 to 3%, is not a big deal as long as wages are also increasing by at least that much. And long term, that has been the case. In fact, wages have been rising faster than prices have been rising in our economy. And so that means that that real incomes are going up. And that's what this graph is showing you. It's showing you nominal wages and prices. And, they use an index here to represent prices, and I don't know how they normalize that y-axis so that you can graph both on the same axis, but just know that if the graph is going upwards, that's an increase. If it's going upwards more steeply, then it's a bigger increase year to year. And sure enough, wages, the green graph, are rising faster than price levels, and this is a 20-year period, 2000 to 2020. So getting back to a loan situation, if you are a bank and you are going to introduce a new loan product, let's say it's a home equity loan, a 10-year home equity loan that you're going to be selling, and if you would like to earn, let's say, 5% interest income per year, you would not put 5% on the loan documents and actually charge the borrowers 5%. Because you have to think about inflation. What will inflation be each of those 10 years? You build in an inflation premium and you add that to 5%, and that becomes your nominal interest rate. And then your real interest rate that you will really earn after accounting for inflation will be something less. Here's a graphic that shows you how this would work. And in this example, this is a bank that wants to earn 5% interest, real interest, and they build in an inflation premium of 6%. Now that's a lot of inflation, so maybe that's like a really conservative inflation premium. So they would loan the money then at 11%. Then, if there really did end up being 6% inflation on average in each of those 10 years, then they would have earned 5% real interest income. If the actual inflation rate ended up being 3%, then the bank earns 8% real interest income. If the inflation rate ended up being 8%, and you get the idea here, then the bank is earning 3% real interest income. So this is what the bank does. They build in an inflation premium to account for expected inflation to give them a better chance of making real interest income. So with income effects, if there's deflation, everything I just said is the reverse. Now, I'm not going to go through all of those situations because we never have deflation in our economy. There was actually one year where we had a very, very tiny bit of deflation not too long ago, but it was just 1 year and it was almost 0% inflation. So I'm not even going to dwell on that. So should you be concerned about this? Actually, no. This issue of does the lender win or the borrower win? Because you are both, once you're in the middle of your career, you are both a borrower and a lender. Think about that. How might that be? Well, you can understand the ways in which you would be a borrower, right? You borrow money to buy a house. You borrow money to buy a car. Maybe you're still paying on your college loan. You borrowed money to do that. You're also a lender, though, because once you get into your career and you're contributing to a retirement plan, and most people will be in what's called a defined contribution plan or a 401k plan, a certain percentage of your income every 2 weeks, if you're paid every 2 weeks, is going into this 401k account, which is invested for you in some combination of stocks and bonds. The portion that is invested in bonds, and let's just say your 401k has 60% invested in stocks, 40% invested in bonds. Well, that 40% of your retirement income that's in bonds, those are loans. You purchase bonds, or your money manager did it on your behalf, and those bonds are a loan. This is a corporate bond or a government bond. In either case, the organization is borrowing the money from you, promising to pay it back after some maturity date with interest income, some specified amount of interest. So you are making that loan. So you're both loaning money and borrowing money in the same year. So the redistributive effects of inflation are not really significant, not something you should worry about. Are there certain demographic groups that are more hurt or more helped by inflation? Not really. Experts say it's sort of arbitrary. Young, old, poor, rich are all affected about the same. Now let's talk about wealth effects of inflation. When inflation happens, in what form is your wealth stored? If you have it all in the bank, a bank account that's earning, let's be really generous and say you're earning 1% interest, well, it is declining in value. Your wealth is declining in value because the inflation rate has been higher than 1% for a very long time. So it is declining in value. That's why you wouldn't keep all of your wealth in a bank account. You keep some, and a financial planner would tell you the rule of thumb is you should try to have 3 to 6 months of expenses in a bank account as an emergency fund, but no more than that, and I wouldn't even have 3 months. There are pretty conservative mutual funds that you can have that money in that are almost as liquid. But anyway, I want to get into that. But you certainly don't want to have all of your wealth in a bank account because it is declining in value. If you have all of your money, all of your wealth in, say, the real estate market, well, kind of a rule of thumb, very long term, real estate has appreciated at about 5% annually. So you are doing better than inflation. So your wealth is rising in real value. That's the point. Now you can do better than the 5% in a good S&P index fund, a mutual fund, or like I said, your 401k long term should do better than 5%, even in the most conservative fund that you choose. Here's some numbers from a 10-year period, 1991 to 2001. Now this was a tremendously productive era in our economy, especially the late 90s. If you had all your money in stocks, then your wealth would have been multiplied by 2.5. How about that? Isn't that amazing? Diamonds went way up in value over the 10-year period, so that's 7.1% per year, you could say, right? Roughly. Average prices went up by 32% over the 10 years. If you had all of your wealth stored in the form of collectible stamps, I hope this wasn't you, because your wealth would have declined in value by 9%. Now, gold always goes in the opposite direction that stocks go in, because when the stock market is doing poorly, some people take their money out of stocks and buy gold, and the demand for gold goes up, and that drives up the price of gold. The opposite happens when the stock market is doing well. Those people that own gold sell their gold and buy stocks, and that drives down the price of gold. Now to summarize the redistributive effects of inflation. Price effects: if you happen to be buying products that are rising in price faster than the inflation rate, assuming your income is rising at the inflation rate, you are a loser. If you tend to buy products that are rising more slowly than the inflation rate and your income is rising by the inflation rate, then you're a winner. Income effects: simple. If your income's rising by exactly the inflation rate, you're neither helped nor hurt. If your income is rising long term by more than the inflation rate, you're a winner. If you're on a fixed income, you're a loser. Wealth effects: if your wealth is stored in the form of an asset that is appreciating in value faster than the inflation rate long term, you are a winner. If you are storing your wealth in the form of an asset that's rising in value more slowly than the inflation rate, or even going down in value, then you're a loser. Money illusion. This is where we get upset when we see prices rising and you remember 10 years ago what you paid for an automobile and you can't believe you're paying so much more today than you paid 10 years ago. And it's an illusion because you're not acknowledging that your income has been rising too, or you would assume so. If not, you should find another profession or certainly another employer. So wages and prices have been rising long term. And if you talk to your grandmother who says she paid 10 cents for a loaf of bread in 1950 or something like that, then again, she's not thinking about the fact that incomes have also risen during that period of time. So here's an exercise. 1980, this was a year where we had a huge amount of inflation, 13.5%. That is a lot of inflation, the most in a long time. And let's say 1979, your income was $10,000. In 1980, you got a $1,000 raise. That would be pretty impressive, right? That's a 10% increase. You can use this equation I give you at the bottom here. I always use this. Whenever you are looking at a percent change over time, it's always the new number minus the old number divided by the old number. The old number needs to be the base. So then in this case, it would be 11,000 minus 10,000 in the numerator divided by 10,000 in the denominator. So that's 1,000 divided by 10,000. That's a 10% increase. So if that was you, your nominal income rose by 10%, but the inflation rate was 13.5%. Your purchasing power actually went down. Your real income declined, didn't it? Now we'll talk about a few different macroeconomic consequences of inflation. First of all, it creates uncertainty. If you're a business and you're trying to do long-term planning, strategic planning, if the price of your product 2-3 years from now is uncertain, it's hard to make plans. If construction costs are rising and you're getting ready to embark on a major construction project that spans 1, 2, 3 years, typically they do, right? Construction happens in phases if it's a fairly significant construction project. It's hard to plan for that if you don't know what construction prices are going to be 3 years from now. Another macroeconomic consequence of inflation is that it causes speculation sometimes. And this happens in individual product markets, the real estate market, for example. If the price of real estate is rising fast month by month, that's going to attract speculators. This happened in the early 2000s. This led to a housing bubble. This further escalates prices of real estate. Because normally when you buy a house or any kind of real estate, you're buying it long term. In fact, you get a 30-year mortgage loan sometimes. Well, speculators in a market like that where real estate prices are rising fast will buy thinking short term that they'll sell in 1, 2, 3 months from now and then make a profit. That's called speculation. When that happens, that increases overall demand for real estate. And if you could picture the supply and demand curves, and if it's the real estate market shifting that demand curve to the right, further driving up real estate prices to unrealistically high levels. This is again what happened in 2004, 5, 6 that led to the Great Recession in 2007, 8, 9. This is speculation. When people are doing this, they're not creating any GDP, are they? Think of day traders, people that just buy and sell stocks all day on the computer. They're speculating. They are guessing, or through their skill, they're trying to buy low and sell high. That's speculation. But they're not really producing any GDP, are they? So when there's inflation, even in a specific product market and not in the overall economy, let's say just in the real estate market, people go into that and do that for their living rather than producing GDP. So it shifts production away from GDP into speculation, which is not really adding any economic growth in our economy. We have in the U.S. a progressive tax system. This means that the more income you earn, the higher your income, the larger the percentage rate you pay in taxes. It's considered moderately progressive compared to European tax systems, but it's progressive. Bracket creep means when inflation is happening and nominal incomes are rising too, that pushes you into the next higher bracket. So the IRS has brackets established, and as you rise into the next income bracket, you pay a higher percentage in taxes. But this is not a serious concern because they adjust those brackets over the years to account for this happening. Hyperinflation is just when there's lots of inflation, like really lots. So here's a good definition. An inflation rate in excess of 200% lasting at least 1 year. Then they call it hyperinflation. Spending accelerates and production declines. So why is deflation bad? Think about this. You might think if overall level of prices come down, that would be a good thing, right? Not really. If prices are coming down and you're interested in buying a car, are you going to buy a car today if it's going to be less expensive tomorrow, or let's say next week? And if it's going to be even less expensive 1 month from now, are you going to buy it today? Or are you going to wait until the price stops dropping? You think it's maybe going to stop dropping at some point in the future. You're reluctant to buy. The car dealer is reluctant to stock inventory because that inventory is losing value day to day. Businesses are reluctant to borrow funds or invest because the price of their product is going down, so why would they be expanding? Incomes would be falling too, just as when there's 2% inflation per year, incomes overall will rise. They'll get adjusted by employers. Well, now incomes are going to decline. So not only are prices going to decline, but incomes are going to decline too. The value of assets are going to decrease as well. And so everything is going to be backwards and upside down. And that's why deflation is a bad thing. In the next video, we will be focusing on the Consumer Price Index. This is one price index, the most common and the one that is most often used to determine the inflation rate. We'll talk about exactly how that is measured, how it's done, and we'll talk about what inflation rates have been, and we'll actually compute some inflation rates. And so that's all coming up in Part B of Chapter 7. See you there.